Hello everyone, this is Mr. Honeya. Today we're going to be talking about financing a home. As you know, we are going to be going through different aspects of buying a home and who's involved in the whole process. And today we're going to be going over the money side of things. So you have a set of notes in Canvas and you just follow along with the video and fill in the notes as I go through. So let's get started. These are just some of the objectives of what you will eventually learn from understanding this little. Then these are some of the terms that we will be going over. We won't be going over all of them, but most of them you will see and recognize, and hopefully you'll come out of here with a stronger understanding. So first we have the home mortgage, and a loan to purchase real estate is called a mortgage. So when you hear people talk about, oh, I have a mortgage payment, I need to, pay my mortgage this month, what they're saying is the bank or any sort of lending company gives a person money to buy a home, and that money is then paid back to these companies, and it's called the mortgage. So, mortgage calculators can help determine how much loan you can afford based on interest rates and the length of the mortgage. So, different mortgages have different interest rates, and they also have um, the different time spans. And you guys will experiment a little bit more with that later on today. So continuing on, interest rate fluctuation. So your interest rate is how much interest you would end up paying back because this is how these companies make money. So that would be like me saying, okay, I'm going to give you $100 but charge you interest, which means whenever you decide to pay me back, instead of you paying me back the $100 I lent you, you may have to pay me back $110, $150, however much. If it's a lower interest rate, you'll probably end up paying back 110. If extremely high interest rate, you'll end up paying me back 150. And the banks and these things work the same way. The higher the interest rate, the more you're going to have to pay back on that loan, and the lower the interest rate, the less you're going to have to pay back on that loan. So amortization is the process of paying your loan in equal monthly installments. So you'll pay this loan in these equal monthly installments, and oftentimes the amount of your monthly payment depends on how big your mortgage is. Obviously, if you have a $500,000 home, that the monthly payment is going to go up. The other thing is what's called the down payment. The down payment is what you pay up front. So if you have $100,000 home and you pay down half of it, well, that's only 50,000 more dollars that you have to pay on top of the interest. So that's different for someone who pays only $10,000 on it, and so it's going to be a little different. And then finally, you have interest rate, which I mentioned earlier. The higher it is, chances are the higher your monthly payment. And then finally, the term of the loan. These loans are not meant to be paid off in a short time span. They're meant to be paid off 15, 20, 30 years. So, a $100,000 loan that's spread over 30 years is obviously going to have a less monthly payment than a $100,000 loan spread over 10 years. So, focus. Did you know in the early part of the mortgage, your payments are applied largely to interest, and then later as you go, they're playing in to the actual principal. What the principal is it's the actual amount that you paid, is the actual amount that you pay towards your house, not exactly the interest of the extra amounts that you're paying towards the bank because they lent you money. So, home mortgage. So, you have private mortgage insurance, which is required by lenders if your down payment is less than 20% of a purchase price. So, if you purchase a home and you pay less than 20% of your purchase price, so for example, if you buy a $100,000 home and you pay less than $20,000 as a down payment, you are required to get private mortgage insurance. And then oftentimes, many lending companies and banks, they can work with you to find ways to get that insurance rate reduced through, um, just sort of financial literacy courses related to housing. And then finally, we also have the escrow account, which is required by your lender to pay real estate taxes and property insurance payments. So it's this little account, money goes into it, and then that money is used to pay for your taxes, used to pay for property insurance. And, it's one of those things that kind of sets the burden off, or correction, offsets the burden because it then makes all of these types of payments part of your monthly payment instead of you having to worry to set aside money every day to make sure that you can make these payments. So you have types of mortgages. You have fixed rate, which means it does not change over time. So you start out paying $1,000 a month. Now you'll end up paying $1,000 a month, 20 years from now. It always is the same. Then you have adjustable rate mortgage, which carries interest rates that may increase or decrease periodically over the life of the loan. So if an interest rate spikes and it's really high, then your payments will go up. However, and then if the interest rates drop, your payments are going to go down. And this happens with the adjustable rate mortgage. And then finally, you have a graduated payment mortgage, which allows for the buyer to pay low monthly payments in the early years in the mortgage and higher monthly payments in the future. And this is basically done because if you think about it, when we start off entry level jobs, we're not making a lot of money, but it's the idea that as we get older, we advance in our careers, we move up in the companies and jobs that we do, then we'll eventually make more money and can make these higher purchases. Now, this can be a good or bad thing because, if you move up, you're going to be able to make those purchases. But if you're stuck in the same job for 20 years, this may not work well for you because now you have to worry about making those higher payments in the future with the same salary or the same hourly wage that you've been earning. So this is just a short little example of how much the interest is on certain things. So for example, you have two two different loans, different amounts. So you have a 30-year and a 15-year. The amount of loans are the same. However, the interest rates are different. And because of that, what happens is you're seeing the difference in monthly payments. So as you see, with the 15-year, your total interest, the money you're paying to the bank, is significantly less, and the total amount you're paying overall is significantly less. However, because of that lower interest rate and as well as the lower term amount, it's going to be less interest overall and less total payments overall versus when you factor in the interest, even though the housing prices are the same, they then increase because of those interests being paid at a longer span of time. So even though you're paying less monthly, at the end of the loan, you've went and paid extra overall. So you have what's called subprime mortgages. These charge higher than your prime interest rates to borrowers with poor credit who often do not qualify for mortgages from other companies. So what happens is if you can't afford a house, typically you can go with the subprime mortgage. However, you're going to be looking at higher interest rates. So if they're higher interest rates, you're going to end up paying more in the long run oftentimes. But these do allow for someone with poor credit ratings to qualify for a home. And then next we have what's called the home equity loan, also called the second mortgage, which is a loan in which the buyer uses the equity from the home as collateral for the loan. As you end up paying on your home, you end up developing what's called equity in the home. And as you end up paying for that house, the best way I can word it is think about your house as a giant savings account. You start paying off, you may buy a house for $100,000, but because of property values and everything else, that house may end up selling for $180,000 in 10, 15 years. So you're building equity in that home, and you're able to basically sell that home and earn that money back as time moves on. So next we have what's called the closing. So the closing date is the deadline to finalize the sale of the home, and oftentimes you have closing costs, which we're going to be talking about a certain type of closing cost related to inspectors as we move on. So closing costs are fees or services that must be paid before a sale is final. So if you do not pay closing costs, oftentimes the sale will not go through and you will not be given the keys to the home. So different types of closing costs that we have are, property survey, where they actually survey the property to see the size, the boundaries, as well as the characteristics, as well as the appraisal. And that's when they bring in an appraiser who actually talks about a written estimate on the value of the home. Also, you look for title search, which is the legal document that proves ownership of the property. So that is what the title is, and the abstract of title, summary of the public records regarding the ownership of the property. So with the abstract of titles, you'll actually see the summary of the records of who's owned the home before you. And then also it's important to make sure that you have an attorney and have everybody review everything, so that way you can make sure that everybody, that the person selling is the legal owner, that the property is free of debts or any title issues. So another thing that exists in closing costs is title insurance, which basically protects the buyer if problems arise with the title after purchase, which, once again, we're looking at other closing costs as well, such as recording of the deed, loans application, credit reports, real estate commissions, and then attorney's fees. So a lot of this can really add up on top of the purchase of your home. So you want to keep that away. So just a couple of just little tidbits of information. Saving money on your mortgage. Do your best to avoid private mortgage insurance by paying at least 20% on the down payment. And then you can make additional mortgage payments each year. Pay additional amounts against the principal and not necessarily the interest. And then refinance your mortgage if interest rates drop. So you'll hear a lot of times about people talking about, oh, the interest rates dropped, time to refinance. So if you go and you can actually go and try to get a company to refinance that mortgage, so you can end up getting it at a lower interest rate.